I just bought 100 NVIDIA shares at 109 and 200 Amkor shares at 52. NVIDIA is the obvious side of the trade, as it supplies the compute. Amkor provides the advanced packaging and testing. NVIDIA trades at around 21 times earnings, near the low end of its range since 2022, while the business is growing massively. Amkor is a different bet. Packaging capacity is becoming more important as AI chips get more complex, and NVIDIA just committed $1.5 billion to support US expansion of Amkor's advanced packaging capacity. So these purchases are connected. One gives me exposure to the dominant compute platform, and the other gives me exposure to a manufacturing bottleneck behind that compute. The NVIDIA case is fairly simple for me. NVIDIA is around 21 times earnings, and that's around the lowest it has been since 2022. Relative to its own recent history, the valuation is obviously compressed. Latest 12 months revenue is about $253 billion, which is up 71%, with a 64% operating margin. And that gives us roughly $160 billion of net income, with $120 billion of free cash flow. NVIDIA also announced that they are raising coal prices by about 15% from 2027, and that is potentially about $50 billion on top of the even full 2026 earnings. That combination is why I bought it. I am getting one of the lowest recent earnings multiples for a business that so far has not started behaving like a slow growth company. Of course, I could have waited the day for the earnings event, but that only changes the price of the stocks. It doesn't change what I want to own. NVIDIA guided to around $90 billion of revenue, with the obvious plus or minus 2%. Expectations are already very high, so the stock can fall even on a record quarter, even though I am not very certain that would happen because we haven't had a run-in of the price prior to the earnings event. I care more about data center growth anyway. Gross margins, next generation product timing, and whether hyperscaler and AI infrastructure spending still looks durable, which it does so far. I also care about the quality of that demand. In one of my recent videos regarding AI financing, I have become much more skeptical of giant compute commitments that depend heavily on aggressive financing, circular capital, or customers whose economics are still unproven. So I am accepting the short-term event risk. If demand, quality, margins, or even guidance deteriorate, then I would reassess my thesis. The purchase so far is based on the relationship between the valuation of the business and not on a 2-day earnings trade. Amkor is the supply chain of the trade that I think it is easier to underestimate. In my earlier supply chain video, I covered why advanced packaging matters. An AI accelerator has to combine processor dice, high bandwidth memory, interposers, power delivery, testing, and everything is done onto one package. More wafer capacity doesn't simply solve the problem if packaging becomes the bottleneck. And that is why I care about the back end of the semiconductor manufacturing industry, rather than only companies that simply design chips. And Amkor is one of the major outsourced semiconductor assembly and test companies, or OSAT for short, and it is definitely the largest US headquartered one. That gives me direct exposure to packaging testing capacity without buying another company's whose main story is selling more compute. If you want the technical background on this matter, I will link that supply chain episode in the description below, because it explains this part of the thesis much more in detail than I would like to go into within this video. On July 23rd, the companies announced a multi-year $1.5 billion worth of strategic partnership. NVIDIA is providing a prepayment to support US expansion of Amkor's advanced packaging capacity, and the work includes packaging and test technologies for next-gen AI and accelerated computing systems. The market did not reward Amkor for long though. After the next earnings release, the stock fell roughly 25%, even though Q2 revenue was very good and it was above expectations as well. The issue was not whether demand exists, obviously it does. Investors were focused on the amount of capital Amkor was spending and how quickly that new capacity can earn adequate return. And that is the tension I'm buying into. NVIDIA is putting real money behind the capacity and the build-out, but the market is no longer pricing Amkor as if nothing can go wrong. And for me, that makes the setup much more interesting than it was when the partnership headline first pushed expectations higher. The strategic validation matters, but it doesn't remove execution risk, and it does exist. And that is why I am treating Amkor as a very different position from NVIDIA, even though both are obviously tied to the same end market. Amkor's economics are nothing like NVIDIA, and that is very important to keep in the thesis. Latest 12 months revenue is 7.4 billion, with an 8.6% operating margin and 558 of net income. Free cash flow was negative 172, and long-term debt is about 2.3 billion. LTM capex of about 1.4 billion, and management expects full year 2026 capex of about 2.5 to 3 billion. So the company is committing a very large amount of capital relative to the current earnings and cash generation. The risk is straightforward. Amkor can build the capacity and still disappoint if utilization, pricing or demand does not produce adequate returns. That is why the lower multiple is not automatically a bargain. The PE chart moved toward 40 several times earlier in the year and has since reset to the low 20s. At that valuation, I am more willing to take the execution risk because NVIDIA is putting real money behind that same capacity that I am investing in. What I need to see though, over time of course, is higher utilization. I would definitely want to see better margins and obviously free cash flow. If the spending rises, but the cash return does not, then Amkor's thesis is obviously wrong, but I very much so doubt that this will happen. The main portfolio risk is that these positions can fall together. If NVIDIA says AI infrastructure demand is slowing, which would be hilarious if they did, NVIDIA gets hit directly and Amkor can get hit because the market will immediately question future packaging utilization. A broad hyperscaler pullback of capex, of course, would have the same effect across the whole supply chain. I would be extremely surprised if that happens, at the very least this year. For NVIDIA, I need earnings and free cash flow to keep compounding even if the multiple never really expands. For Amkor, I need capex to turn into utilization, profit margin improvement as mentioned, and positive free cash flow. And that is the whole portfolio logic behind these two purchases. NVIDIA is the quality leg, with exceptional margins and cash generation at a multiple near the low end of its recent range. Amkor is the bottleneck leg, advanced packaging, a valuation reset after the sell-off, and a 1.5 billion NVIDIA commitment, supporting additional US capacity, as well as Taiwan Semi partnerships. Earnings in a day can move both positions hard, but I am not buying for one evening. I am buying because I think the AI supply chain economics still make sense over the next years. If you want the technical reason of why I care about packaging, watch my AI supply chain episode on advanced packaging next. That is the background of my Amkor position bet.